Good afternoon, folks. How's it going? All good? Just to double check, you guys can hear me okay? Let me know in the chat. Perfect. Thanks, Barrett. So, Friday afternoon, let's kick off. So first of all, what I'm going to do is I will give you a very brief background about myself, and then we will basically just get started digging. I'm going to share my screen. I'm going to show you guys a lot of different stuff here, and hopefully some of it should be pretty useful. So a little bit about myself. Chartered accountant, trained in both practice and industry. After qualifying, I set up an accounting firm in 2015. Grew that to a couple of hundred clients, just a small firm, then sold it in 2019. And then worked as a CFO for a tech startup, then a group CFO for a company which followed a model similar to private equity. So where you have kind of a holding company on top, multiple different companies underneath, build them up, then exit them a few years later. And then after that, I have been working as a fractional CFO, more in the true sense of it, working with multiple different clients, different sectors over the last few years. So with that little introduction being done, let us get started. So I will now share my screen. I'm using a new streaming tool here called Restream last week. I just did it directly from Zoom. So hopefully this will work. So if I hit share screen, then I hit entire screen, and I hit that one. Yeah, perfect. Okay, cool. So now let me change the view. Yeah, that works quite well. Okay, cool. So what we have here is, this is kind of the internal operating model. It's a work in progress that I'm building for my my fractional CFO firm, because I plan to scale things up next year. And we have a few different sections. So we've got like onboarding and discovery. We've got some marketing stuff there. We've got how to go through a full data cleanup for a new client, which I will touch on a little bit throughout the webinar. How to actually implement a full forecast, and then kind of what happens business as usual. And this is very much just a work in progress. I'll be building this out a bit more over the next month or two to have the full operating model. But for today, we're going to focus on onboarding and discovery. So what we're going to do is I will chat through kind of how to approach the first 30-minute call with a client, then explaining what actually is a fractional CFO. Then we're going to cover my mind map session, and I'll run you through how I do this. Then how to kind of write a strategy document for a client, and how to analyze their financials at a very high level. And I'm also going to jump straight into Fathom as well, the tool I use for forecasting, show you a little bit of how I do that and some of the reporting that I produce from it. And then we're going to talk about a fee quote, so how I roughly go about quoting fees for a client. Then we're going to talk about the implementation plan, so what happens in the first 3 months when working with a client. And then kind of the ongoing engagement, so what happens every month once everything's all been set up after the first few months. Just looking at the chat. Yeah, all good now. Perfect. Cool. Okay, so first of all, initial 30-minute call with the client. So you've been posting heaps on LinkedIn, you've been going to networking events, all that kind of good stuff, and you get a client who is interested in working with you as a fractional CFO. So this is how I go about doing it. I'm not saying it's the right way, the wrong way. This is just how I do it. I will also caveat everything I'm about to show you and say that I primarily work with professional services B2B companies, so somebody that offers a service in the 1 million to 20 million range. So I'm not a manufacturing CFO, not a construction CFO, I'm not a SaaS specialist CFO. So your processes might be a little bit different to mine, but this is how I do it for service companies. However, the first kind of initial 30-minute chat with the client should be pretty universal to everybody. So in terms of kind of the first kind of questions and how to approach it, the first 15 minutes, it's really, really important to make this all about the client, because the last thing you want to do is come in and pitch slap them and basically be like, hey, nice to meet you. This is what I can do for you. The first half is all about the client. The second half is all about you. So I usually just start, keep it pretty easy. Say, hi, how was your week been? How was your weekend kind of thing? Establish a little bit of initial rapport. Then then I say, hey, I'd love to hear your story. So like, what's your background? How did you end up doing whatever you're doing in business? And most importantly, why do you think you need a fractional CFO? And while the client kind of explains their background, why they're looking for a fractional CFO, listen out for kind of any key frustrations or relevant information that you might be able to weave into your pitch. So the second half. So for an example, if a client says they've built up a lot of cash and don't know where to spend it for growth, that means they've got a capital allocation problem. So I can focus my part of the pitch on how to address their specific capital allocation problem. The same as, for example, they might say, oh, I meet my accountant once a year. I'm a £3 million company. We get all these year-end adjustments. I don't really feel like I've got clear financial information. Then, okay, great. I can kind of focus specifically on reporting a bit more than I normally would, because that's their kind of key pain point. Excuse me. So I will kind of explain my background just like I did at the start here. Then next, I will explain what a fractional CFO actually is and what they do, because fractional CFO is kind of a new term on the market, and it's quite a confusing one. Everybody knows within reason what a bookkeeper does. Everybody knows within reason what an accountant does. But fractional CFO, what does that really mean? Let's find out. So this is an image I use on my initial calls. So this explains it pretty well. So we look at the bottom, transaction processing. That's what a bookkeeper does. Reporting, that's what an accountant does. So transaction processing is bookkeeping, maybe payments, etc. Reporting might be some basic management accounts, your compliance, your payroll, your VAT, your tax efficiency advice, etc., etc., etc. But what a fractional CFO does is the top three layers of this pyramid. So budgeting and forecasting, analysis and insight, and strategy. And there is one key thing that a fractional CFO should be doing, and that is linking finance to strategy. I feel that's my job as a fractional CFO, is to make the finances link directly to the strategy that the company, the board, the shareholders want to do. And that usually kind of gets the client thinking, okay, cool, I kind of understand that. My bookkeeper does that. My accountant does that. You're going to do that. Great. So it kind of cleared up a little bit of ambiguity in terms of what actually is a fractional CFO. And then next, I will show them a mind map session, which I run through. So I will show that to you guys now. So if I come here, check that screen share is fine. Yes, it is. Cool. So this is a tool called MindMeister, and this is a mind map. So what happens here is after the first initial 30-minute call with the client, I say to them, the next step is to hop on a couple of hours, usually, call with me. And they're free to invite any of their other board members, shareholders along. And we run through this in real time. So as I'm asking these questions, the client's kind of giving answers, and I'm actually typing out in real time what they're answering. When I'm not typing random garbage, can type pretty fast. And I'm also asking follow-up questions as we go along. So we started with kind of the value proposition. What problem does the business solve for the customer? Client might give an answer. I might dig a little bit deeper to get a bit more meat on the bone in terms of the value proposition. So it's not simply a case of asking these questions, thank you, move on to the next. You are kind of diving in a little bit deeper in each one. So let's kind of run through this mind map so everybody understands it. So the right-hand side of this, infrastructure, customer, financial, if you're familiar with the business model canvas, this is broadly based off that. So we would start with the value proposition. So what problem does the business solve for the customer? The key activities. So what does a business actually need to do? What are the key things a business does to solve that problem? The key partners. Who are the key suppliers and partners for the business, and what do they do? And what are the key resources this business requires? Is it assets? Is it people? Is it intellectual property? That kind of thing. Then we move on to the customer. So we have a look at customer segments. So who actually are we creating value for? What customer segment? Who is the ideal client profile for this business? And who are the most important customers in that client profile? Is it business to business to customer, et cetera, et cetera, et cetera. Then we have a look at the customer channels. So we're kind of touching on a little bit of marketing here. So what channels are the customer segments reached by? Is it Google Ads? Is it LinkedIn? Is it founder-led strategy? Is it SEO? And how are all these different channels integrated together? Then we have a look at the relationships. So how does a company actually establish and maintain these relationships with the customer segments? And how costly are they? And then we come on to everybody's favorite, especially for a fractional CFO, the financial part. So remember, at this point, I have not seen any client data at all in terms of the finances. So I ask these kind of top level questions just to get an idea of how kind of financially savvy the client, the board are, and how much level of detail, technical detail, I would need to go into when I come to do my strategy document, which I will explain after this. So on the financial, I just asked some really top level questions. So what's your current pricing structure? How do deals, discounts work? How do customers pay for the product? What are the most profitable revenue streams? Very important question, this one. I would say probably 9 out of 10 clients. If I say to them, okay, what is your profit per customer for your top 10 customers? They won't be able to give me that answer due to poor transaction processing, poor bookkeeping. And what are your quiet and busy months? Then cost structure. So what are actually the most important costs in this business model? Cash flow. Does the business have cash flow pressure? Is there any seasonality? Is it mostly recurring income, etc.? And then high level question, what's your average gross margin and what is your average net margin? Then we move on to the left hand side. So we have a look at the systems map. So this is me kind of mapping out the tech stack for the business. So what are the core software systems this business uses? Is it Microsoft? Is it a Google Suite? Is it HubSpot? Is it Asana? Etc., etc., etc. So we've got a kind of fairly detailed kind of tech stack for this business so I can see what I'm working with. And then we move on to the most interesting part of this entire exercise, which is the key questions. So we first of all have a look at the business goals. So what is the growth plan for this business? Different founders, different businesses all have different growth plans. Some want slow and steady growth. Some want to really hyper scale aggressively. And there is no right or wrong answer to that question because every business is unique and different shareholders have different aims and objectives. And then what's the 3-year goal for this business? And if there is one, do you have a revenue and net profit figure in mind? The answer always is no to this question generally, because they're coming to a fractional CFO for better forecasting, better insight. And in terms of the 3-year goal, what are the main things that might stop this being achieved? Then we move on to when do the shareholders plan to exit this business? So sometimes the shareholders in the business can be two very different things with different goals. So if you took the example of, let's say, a business was wanting to exit via an EOT, employee ownership trust, the shareholders in the business would have different goals there. And would there be any concerns around the shareholders exiting the business? Then we come on to some challenges. So high level questions. Number one, what's the biggest frustration right now with your business? Number two, what's the number one priority in the next 3 months? Then we have a look at sales and marketing. What are the issues here? Operations and staff. What are the issues here? And how is the culture? And funnily enough, sales and marketing and operations and staff can actually end up taking the most time out of this entire document, which is quite funny considering I'm a fractional CFO. I'm not a sales and marketing or an operations person. But yeah, it's just a strange observation that these can take up a lot of time and often end up being the biggest parts of this entire thing. So if we imagined we had been going at this for a couple of hours, we had run through all of these questions, I had asked lots of follow-up questions, etc. If we zoomed out on a completed version of this entire screen would be full of big mind map covering the infrastructure, the customer, financial, tech stack, and really the kind of key questions, the goals of this business and the challenges they're facing. Reason I do this is it links back to that diagram I showed you before. The key thing about a good fractional CFO is linking finance to strategy. This gives me a much better strategic understanding of the business. I'm not just looking at financial, I'm looking at the infrastructure, the customers, the tech stack, high-level challenges, etc. And then after that session is complete, what happens is I will then ask the client for some follow-up information. And that follow-up information is I will ask for guest access to their accounting system, whether that's Xero, QuickBooks, Sage, doesn't matter. My only rule is it has to be cloud accounting software. If a client's on Sage 200, NetSuite, whatever, I will not work with them because it is generally not a good fit, and I have learned that through experience. Then I will also ask if they can send over any current business plans they have, any current budgets, forecasts they might have in Excel, any corporate communication documents, any internal presentations, basically anything that might be useful for me to write a strategy document. And once I have all that information, the output of that is a full financial and strategy analysis with a copy of the completed mind map included. The word count, usually between 2,500 to 4,500 words. I think the longest one I ever done was about 7,000 words or something. And I do not use AI to write this document at all. No AI. You wouldn't see it. You wouldn't see any EM dashes. You wouldn't see any AI formatting. Reason I don't use AI to help with that is because this kind of work, I feel it's not good to outsource to AI because this is critical thinking, learning how to analyze strategy, get your own thoughts, bring everything together. And it's a skill that I do not want to degrade by outsourcing it to AI because it is a very important skill, especially if you are operating at board level. So I will go in, do my financial analysis, have a look at all the documents, and the course structure output generally works like this. I will start with finance. After all, they've engaged me as a fractional CFO, so I'm going to start with finance. Then I will have a look at marketing next. Then I will have a look at operations and strategy. Then I will give an implementation plan, 30, 60, 90 days. So what's going to happen in the first 30 days? What's going to happen in the next 30 days? And finally, what's going to happen in the final 30 days? And I will also give them a fee quote. In terms of coming to kind of the marketing side of things and the operations and strategy, because I work with professional services, B2B companies, 1 million to 20 million, a lot of them kind of face the same strategies around marketing and the same problems around marketing and operations and strategy. So some of that can be kind of copy pasta from previous analysis and just changed around a little bit. But the finance is always absolutely core and unique to that particular client. And I will quite freely give my opinion on their marketing, on their operations and strategy, on any problems that they have specifically highlighted in that mind map. I will say, okay, based on my experience, this is what I would do. You want to give your opinion because you want to be a respected board level advisor. So giving your opinion is always a good thing. Could be right, could be wrong. At least you're giving your opinion and kind of getting that level of respect. And in terms of the kind of financial analysis side of things, so if I was looking at client zero account, for example, this is kind of how I would go about starting it at an extremely high level. So this is just a quick overview. This isn't a full process. So the reports for analysis I would look at would be annual P&L, last 5 years, balance sheet, last 5 years, monthly P&L, last complete financial year, monthly P&L, last 12 months rolling, and a direct cash flow analysis if available. Then we just carry out some basic high-level analysis. So have a look at some variances, revenue, is there any seasonality? Is it recurring income? Are there any big spikes? Same for cost of goods sold. Have a look at the GP margins. Have a look at the admin expenses. Are there any big variances in there month to month, etc.? Have a look at net profit percentage. Look at balance sheet variances. So current assets, current liabilities, working capital, fixed asset growth, any bank account variance in terms of cash. Then have a look at free cash flow. So I just like to measure it simply: net profit after tax minus dividends, director loan, minus loan repayments, minus capital expenditure. So basically, how much free cash flow does the business have to either reinvest in the company or pay out dividends to shareholders? Then a little bit deeper on the P&L. So if we're looking at the chart of accounts, so is the revenue sensibly split per service line? One common thing might be all revenue dumped in sales, one code. That's not really going to help us do some good analysis. We really want that split a bit more sensibly. In another session, I will cover this in a bit more detail. For instance, I've got a data cleanup part here, which goes into a bit more detail and kind of how to split stuff out. But that is for another session and another webinar. So going back to where we were before, which was here. Chart of accounts, our direct costs split by service line, our admin expenses sensibly grouped, staff costs, kind of similar to revenue. I quite often see all salaries dumped into one line with no split of direct or indirect costs. And if you're not splitting your direct salary costs and putting them as cost of sales, you're not tracking your gross profit margin correctly for the business. That happens for literally every client. I've never come across a client that has a sensible split of salaries between teams and direct and indirect costs. Have a look through general expenses, what's hiding there, customer and staff entertainment, depreciation, corporation tax, are there monthly provisions provided, and have a look at tracking / projects. So are we tracking profitability per customer, for example? Sometimes not a huge deal, as they may have that in an external system, but it's always good to see in the accounting software if we can. Then just kind of having a look at the balance sheet in a bit more detail. So we want to have a look at aged debtors. So are there any zombie entries or negative balances on the receivables ledger? So by a zombie entry, I mean, it could be a random £800 credit sitting on aged debtors that's not been cleared in 2 years. That would be an example of a zombie entry. And basically, whether the aged debtors make sense and if there's any credit control problems, our DSO, days sales outstanding, they're a long time, etc. Have a look at payables. Again, any zombie entries or negative balances in the payables ledger. Is the payables ledger sensible? For example, if a £5 million revenue company only has 15K sitting in aged payables / trade creditors at a month end, that's going to ring alarm bells because that sounds like fiction, which would probably indicate that there's a bookkeeping problem. And are any age payables outstanding for 3 months or longer? Then we have a look at fixed assets. So do we have a sensible capitalization policy in place? So I generally don't bother capitalizing anything under 500 quid. Is depreciation properly posted on a monthly basis? Have a look at the main taxes, PAYE, corporation tax, VAT. Are these all up to date, reconciled correctly? Are there any historical penalties? Have a look at loans. So any director loan, any issues here? If it's overdrawn, has Section 455 tax been accounted for and interest posted? Accruals and prepayments, are these actually done on a monthly basis, or are they just all kind of done via one massive year-end adjustment? Have a look at bank and credit cards. Are these reconciled, petty cash, etc., etc.? Is there large cash balances in one account? 85K, I believe, is the Financial Services Compensation Scheme limit for protection. So if there's any opportunity to improve the treasury management of the company, we can maybe have a look at there. Are dividends sensible in terms of retained profit? And then everybody's favorite, other debtors and other creditors, generally used as a dumping ground. So what's hiding in other debtors? What's hiding in other creditors? And is there a suspense account? And what is dumped in there? And that is how I would kind of go about just very high level initial financial analysis. And that's how we'd focus on the finance side of things. And yeah, the output is a long form strategy document. Everybody has their own kind of superpower. Some people are great on video. Some people are great at writing. Some people are great at going up on stage, giving presentations, whatever. What I'm really damn good at is writing and putting together kind of really in-depth, logical strategy analysis that can be written in a way that anybody can understand them. So as part of my client onboarding, I'm leveraging my superpower. So whatever your superpower might be, try and leverage it. And at the end, once they have got that strategy document, I give a fee quote always, because I already have all the information I know about the business from the mind map. I've seen the financials. I can be fairly confident in giving a fee quote. And in terms of the fee quote, the way I work is a fixed monthly retainer, no minimum contract, simply rolls on month by month. And interestingly, this strategy document, all this analysis, which usually takes me 7 to 10 days to complete after I receive the information, I don't charge for it, which may seem a bit crazy. But the reason I don't charge for it is I'm interested in building a long-term, ongoing engagement with the client. I don't generally do short-term engagements or short-term projects. It's all monthly retained work. And because fractional CFO is a fairly new term in the market, I kind of want to show up front to the client, look, I'm here to build an ongoing relationship with you. And I want to prove to you I'm the right person to help you and your business get to that 20 million mark where you will need a full-time CFO. And it usually goes down pretty well. And in terms of the actual fee quote itself, so when the client receives the strategy document and a copy of the mind map, the fee quote is given. So this is my very, very rough fee structure. So minimum fee I'll charge anybody is 2,500 a month plus VAT. That would likely apply to a 1 million to 3 million company. Between 3 to 6 million, probably looking at about 3K. Between 6 to 10 million, probably looking at about 3,500 to 4,500 a month. And over 10 million is basically POA. Or it's over 4,500. It depends on the client. So, yeah, no minimum contract either, and fixed monthly retainer. And I work with, like I mentioned at the start, B2B professional services companies that are a lot easier to work with than, let's say, a manufacturing company or construction company. It's really just people providing a service. So it's pretty clean. Once you've cleaned up the data, the finances are not too overly complicated. And in terms of professional services, B2B companies, I like working with them. It's fun. They're established businesses. They're selling a service. It's where I've got experience. I've been there, done that myself. So really fun to work with. And before I come on and show you guys the implementation plan, I want to show you Fathom. So in terms of Fathom, this is what I will actually show the client live on this first 30-minute call I have. When I'm doing my little pitch in the second half, Fathom is really good because it can be used like as a sales tool almost. because the client wouldn't have seen this kind of thing before. So it's almost like an oh my God moment for the client. They're like, wow, this looks great when I show it off. So in terms of that, let me show you a little bit about Fathom. So this is a demo account. This is not real client data, of course. So way Fathom works is it's all about three-way forecasting. So three-way forecasting means P&L, a balance sheet, and a cash flow statement. All three interlinked, all forecast at once. So for example, if we updated something in the P&L, changed the figure to whatever, then cash on hand is going to change. Corporation tax liabilities going to change. Aged receivables is going to change. Cash projections are going to change. Everything's all kind of interlinked together in this kind of three statement model. And we can also set up these little kind of what's called in Fathom micro forecasts, which are kind of what if scenarios. So for example, if the company wanted to hire a member of staff, we could create a new micro forecast for staff and hiring. And if we turn that on, there's no data on that one, but that would automatically update our baseline forecast for P&L, balance sheet, cash flow, and we can kind of turn all these different assumptions on and off and kind of use that to make decisions on the business. So really kind of good for off the cuff kind of decision making, scenario planning, all that kind of good stuff. So we can really kind of test out new assumptions on the business and how that will impact profitability, cash flow, working capital, etc., etc., etc. We can also kind of layer different scenarios on top of this. So we can create kind of three different main scenarios: best case, medium case, worst case. So we can stress test the financial model of the business. There's also some other cool tools like if we go into here, goal seek's quite nice. So if we were looking at the performance of this business, so let's say for the quarter in this demo, saying Q2 2023, and we were looking to increase the operating profit margin from 3.68 to 5%. What would be the most sensitive levers that we could have pulled to get our target of that 5%? Well, if we increased our price by 0.83%, we get that close to our goal. If we decreased our fixed expenses by 0.81%, we get that close to our goal. And there's a few other bits of cool analysis that we can do in there. But what I really want to show you guys is reporting. So this is a custom report I have built myself. This is not an out-of-the-box report from the software. And sorry, there's a small fly attacking me. Let me just shoot away. There it goes. So this is what I present every single month to the client at their board meeting. So first of all, we will start with an annual forecast versus year to date. So left-hand side column, this is what we forecast for the year. Medium column, this is our year. Medium column, middle column, this is our year-to-date performance. And the right-hand side is the variance. So the difference, what's the gap? Then what we do is a year-to-date forecast versus a year-to-date actual. So if we were using the most recently completed calendar month, our forecast year-to-date when we first did our forecast, so our forecast from January to September was this figures, but actually at the end of September, we achieved that. This is the difference. And then what we would do is we would dig into a bit more detail on the variances. So why was our revenue 25K over in this example from what we forecast? We would want to find out the reasons why. So was it we done a new marketing campaign, which led to a few new customer inquiries, etc., etc. Same for cost of sales, expenses, etc. We kind of want to dive into detail on our variances and find out why we are over or underperforming. And then we would do that on a monthly basis as well. So for the month of June, in this example, our revenue forecast was 440K. We achieved 429, variance difference of 11K. So then we would want to find out why. We might need to speak to the sales team. We might need to speak to the marketing team, it's not just looking at figures, it's speaking to the business and finding out the difference, why our variance was out, and what we can do to improve that going forward. We always want our budget versus our actuals to be as low in variance as possible every single month. It's impossible to be spot on every month. Anything can happen in a month in a business, but our objective is always to close the gap as much as possible. And then we would just go into a bit more detail on each of the key sections. So revenue, kind of what happened, why did it happen, and so what, or what's next. This is the kind of three questions you should always follow for any kind of variance analysis. We don't just want to go, revenue was down by 10K. That doesn't help anybody. We want to know why it happened, so what, and what's next. What are we going to do? And then we would just go into a bit more detail. So line by line. So, okay, revenue was down, but coffee was down 5.7K, but we actually saw a 1.8K increase in tea. And we would just break down each section in a bit more detail. So cost of sales, have a look at each line item, have a look at our forecast, have a look at the variances, explain the variances, use that information to feed back to management to see if we need to update our forecasts in future. Gross profit, same idea. Expenses, same idea. Net profit before tax, cash availability, cash flow. Then I always like to see a comparison versus last month. So the top section here is all about our forecast to actual. This section is about month-on-month comparison. And we do the same. We have some more commentary underneath there as well. And also, in terms of these reports, it's not just financial data we pull through, it's non-financial data as well. The aim of this report is to present a full business analysis every month. And that's a good thing about Fathom. It can pull through any sources of non-financial data we want. So you can see down the bottom here, randomly, we have customers. So new customers, one, number of website hits. In a full version of this, we would speak to the operations department. What are your top 5 KPIs? Marketing department, what are your top 5 KPIs? Sales department, what are your top 5 KPIs? Health and safety department, what are your top 5 KPIs? We always start with the top 5. And then we start tracking each department's non-financial KPIs as well. And then let's say the CMO is in the board meeting. When the CMO is going over their section, they might explain their variances in terms of forecast versus actual. So now we are getting to the stage where we're being a data-driven organization. We're not using hope as a strategy. We're looking at data, and each member of the board in their respective function is kind of explaining from a data-backed approach. Then next section, year-on-year P&L and balance sheet. Basically, historical would be there. So we might have 2-3 years of historical actuals. Then we would have our shaded column, which is our current forecast for the entire year, just so we can see a quick glance at our margins year on year. We'd also have balance sheet underneath. Then we get into a little bit deeper analysis. So a high level overview. So total revenue year to date, gross profit margin year to date, operating profit margin year to date. And then, this has gone crazy because I think back in our main forecast, we changed one of the figures to be like 2 billion or something. So now it has spiked very, very high. But what would happen here is we would see, actually, hold on. Let me change that because it looks just a little bit too crazy. So let me just make that like 200K. So now if I go back to reports, go back to where we were before, just down here. Yes, we now look a bit more sensible. So green shaded is actuals, unshaded is projections. Gross profit is our purple line. Profit before tax is our blue line. And this is very good for people that are perhaps not super financially savvy. Just seeing that visualized on a graph makes quite a big difference in understanding the key financial impacts. So we would have that for this year, and we would also have it for next year. So our current year forecast, then our next year forecast. Then cash flow as well. So cash on hand this month, cash on hand this last month, net cash flow. So net cash flow being total cash received into all bank accounts minus total cash spent out of all bank accounts. And cash in bank is our blue. Net cash flow is our red. And this helps visualize cash flow for the business. So, for example, we know a VAT return is due for payment every 3 months. We know corporation tax is due for payment 9 months and 1 day after the company year end. So, naturally, if we're looking at this kind of graph, we would expect to see net cash flow decrease every third month due to paying the VAT. And we would expect to see, assuming the company's fairly profitable, quite a big decrease 9 months and 1 day after the company year end for the corporation tax bill. Again, this is really, really good for non-finance people basically to have a look at, because it just makes understanding the trends a little bit easier. And we would also have the same for our forecast next year. Then we just go into more detail in each section. So revenue, year to date this month, last month, total revenue, revenue this month, top performing accounts, revenue mix, same for cost of sales, same for gross profit, same for expenses, net profit before tax. Then we would have all our non-financial data here visualized, reported on, same way as we do with the financial data. Then at the bottom, we have our traditional line-by-line three-wave forecast. So we're forecasting out P&L, line by line, balance sheet, line by line, cash flow, line by line. Purple column is our current month. Everything before purple is actuals. Everything after purple is forecast. So we've got some really deep analysis here at the bottom, but some people might just be interested in these parts, the high-level overview. But the information is there if anybody wants to dig into a lot of detail, ask questions, etc. We've got a lot of information to kind of back us up there. So going back to after the strategy document, all of that, here's the implementation plan. Here's how it normally works. In terms of fractional CFO, there's 3 key stages. Number 1, discovery. Number 2, implementation. Number 3, is business as usual. I just showed you discovery. This is a very kind of brief overview of implementation because I have implementation covered in this section here, which I will probably do a separate section on, assuming you guys are nice enough to let me know that this was actually useful and wasn't a waste of time. So in terms of the implementation, month 1 is always data cleanup. So we need to reorganize our chart of accounts, our financial data, reallocate the P&L to get kind of true gross profit and accurate split for reporting, tidy up chart of accounts, build our first Fathom report, which is always focused on historic and year-to-date performance, and then attend the first board meeting, present that Fathom report to the client, ask them for feedback in terms of the layout. What did they like? What did they don't like? Do they want anything else included? Then month 2, once we have our financial data all clean, then we kind of look at our forecasting. So building the forecasting methodology. We'll start with easy stuff like fixed costs, salaries, software subscriptions, stuff that we know the information's easy to get. And we will then forecast forward the known balance sheet items that are fairly easy. So depreciation, loan repayments, etc. Then one of the more difficult parts, especially for a service business, is revenue and direct costs. So how do we actually go about forecasting revenue and direct costs, especially for next year? And we don't just want to say, okay, we'll use whatever we achieved last September plus 10%. That's no use. We want to go into detail and take a driver-based approach to build our forecasts and be a little bit more scientific than just adding a random percentage. But that is for another session. And then we would attend the next board meeting, present our initial forecast, and discuss that with the board, see what they think, see what we need to change. And then month 3, we would further refine our forecasts, and we would also start to bring in our non-financial KPIs, Sometimes that can come in a month too. It just depends how long the data cleanup takes. And we also want to enhance our forecasting as well. So currently, we would build our forecast out to the end of the financial year. So in month 3, we might want to extend our forecast out to next year also, and that can take quite a lot of time. Sometimes it can bleed into month 4, and then from month 4 onwards, if we do want to extend all the way out to a long range plan for kind of a 3 to 4 to 5 year forecast, then we certainly can. And that's basically how the implementation plan usually works. And in terms of the ongoing engagement, so always the client always gets 3 things as standard every month. Number 1 is the Fathom report, which is always sent 3 to 4 days prior to the board meeting, along with detailed commentary. So everybody that's attending the meeting gets a chance to read through. We also have a forecast meeting. So the monthly forecast meeting, purpose of this is to ensure that month end is closed properly. Accounting data is garbage in, garbage out. If we're not closing our month end properly, doing our bank reg, doing our prepayments, doing our accruals, doing our deferred income, posting our depreciation, putting in our corporation tax provisions, etc., 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 we'll be working with bad data. There's no point in working with bad data. Otherwise, our forecasts are just a work of fiction. So ensure the month end closes properly, forecasts are updated, capture any new developments or changes in the business. So for example, the business decides, okay, we're short on the sales team. We want to hire two new salespeople. Okay, cool. That means we now need to go into Fathom and model out the impact of the business on hiring these 2 people. How does it impact profitability? How does it impact cash flow? All that good stuff. And then update our forecast for any other kind of strategic initiatives that the business might be undertaking. And just to kind of repeat myself a little bit, in terms of the month-end close, full balance sheet rec, etc., etc., etc. Already said all that stuff. So forecasting, how's the sales and cost of sales changed for last month? So has the sales pipeline changed? Any advanced leads, any advanced stage leads not convert? Did we incur any additional direct cost to deliver the work? Any changes in overdue debtors situation? And in terms of future sales pipeline for a service-based company, I always like to do it with 4 different gates. So 100% would be clients signed the contract, will be sending their first invoice out in X number of weeks or months. 75% confidence means we're at very advanced stages and there's a really good chance the client's going to sign this contract and we will start working with them over the next few months. 50% advanced stage kind of negotiations, still some questions going back and forth, but probably a 50-50 chance we will sign this client. And then 25% confidence, which is very early stages. And the reason we have these different gates is if we think back to Fathom, those little micro forecasts I showed you on the side, we can turn on and off those different gates for our sales to forecast in stuff. So we had like a 75% gate, 100% gate, 50% gate, 25% gate. So if we didn't convert our current pipeline of 25% confidence and 50% confidence, how would that impact the business? So that's a really easy way to do some kind of scenario planning there. I won't bore you with the rest of the forecast meeting, but the second meeting is the board meeting, which I will attend. I will stay the entire time for the board meeting. I will talk through the Fathom pack, and I will also act as an NED, non-exec director, and give feedback on any other strategic challenges. So the CMO's got an issue, operations have an issue, there's an HR staff issue. I'm there to give my opinion. I've worked with multiple different companies in the B2B professional services companies, so I can give some pretty decent advice sometimes. So key things, and also just to mention, I give ongoing email support, unlimited within reason, for any ad hoc queries and dealing with anything. So what we've done here is we've kind of, if you think about it, we've almost built a little product here. So the product is powered by the Fathom board packs. We have our forecast meeting every month to update it. Then we have our board meeting to present the Fathom output every single month. And it works really well. It probably took me about a year to get to this stage. This seems fairly self-explanatory, perhaps. I don't know. But this initial process is through a hell of a lot of trial and error and figuring out what works and what doesn't work. And with that, that's the end of what I have to show you today. Like I said, I have lots more information. I've got multiple other whiteboards. This one's just my operations whiteboard. I could probably do a series of about 10 showing all this different stuff. And yeah, let's call it a day for there, but we still have time. So what I'm going to do is I'm going to turn off my share screen. So I can figure out how to do it. Stop sharing screen. There we go. That worked. So I will pass it over to you guys. We've got about 10 minutes left or so. Would anybody like to ask me a question about anything? You can ask me literally anything you want, and I will answer. Even if it's not about fractional CFO. And hopefully, if I go into chat, I will be able to see your questions. I can't seem to see any questions. Maybe nobody's got anything for me. Makes my job a lot easier. I'll give it a few more minutes, but while I wait for any potential questions to come through, I would really appreciate your feedback, guys. Whether you find this useful, feel free to send me a DM. I'm happy to answer any questions you might have. If you want to collaborate with me in any way, I'm always open to collaborations. If it's a good fit on both sides, if I can help you, then great. I have worked with a few accounting firms before, for example, and kind of helped guide them through this entire process, kind of getting to the stage of offering the product as a fractional CFO. So if you think that might be helpful, I'm more than happy to have a chat with you. We have a question. Mark, interest to know why there are any specific accounting packages that you don't want to work with. Okay. So the reason I will not work with some specific accounting packages is because Fathom does a direct link into the cloud accounting software. So that means the information is pulled through automatically on a daily basis, 24-hour refresh, or I can do a refresh at any time by simply hitting the refresh button. However, if it was a client on Sage 50, Sage 200, etc., we would need to do a manual import every time and upload a manual chart of accounts every single time. And to be honest, it just turns into a complete pain. It is a hell of a lot easier just to work with clients on one of the cloud accounting software packages. Makes my life a hell of a lot easier. So that's why. Another question: to populate Fathom, do you first vet what's on the source accounting program, i.e., that it reconciles to audited published accounts? Yes, always. Linking back to that kind of pyramid diagram I showed you guys before, clean data is absolutely everything. That's why month number one, the first 30 days spent with every client is on the financial data. It has to be investigated. It has to match the statutory accounts. It needs to be clean data. There's no point in me doing all these forecasts, putting together all this fancy charts and graphs if the underlying data does not match the statutory accounts. It's just going to be garbage output. For example, if the corporation tax is wrong, that's going to massively impact cash flow. If we've undershot the corporation tax provision by like 60K, that's 60K the business might have thought it had to spend on a new member of staff, but because the accounts don't match the financial data doesn't match the statutory accounts, we would have missed that. That's bad. So yes, very, very, very important that the source data is as clean as it possibly can be. Okay, another question. Dan, how many clients do I carry at one time? In my opinion, one fractional CFO can handle about 7 to 8 clients maximum. Any more than that, the service level starts to get degraded a little bit. So 7 to 8 is probably the max. Maybe 9, maybe. The reason it's difficult is because the first 3 months spent with any client are always the most time intensive, because you have to do that data cleanup, you have to get the forecasting set up, you've got to get the reporting set up, etc., etc. After the first 3 months, the time requirement kind of drops off a little bit. But if you're working with 3 new clients in 1 month, you're going to be extremely busy for at least 3 months, extremely busy, because you're still working with the rest of your clients, kind of thing. So yeah, 7 to 8 safe, 9 at an absolute stretch. Stephen, no questions, but great presentation. Thank you, sir. Much appreciated. How many free 7 days work do you do per annum, i.e. new client onboardings? I don't know. It's not something I track. I don't see much value in tracking it. I do the discovery. I do a good job. The client signs up. That's a recurring fee. And all my engagements are long-term engagements. I don't do short-term engagement. I'm there with the life cycle of the client until they need me. So I can't answer that question. I don't think it's a metric worth tracking. I guess one could say it's because it's kind of rolled up into the monthly fee. I do a hell of a lot more. I do the discovery for free, loads of work in the first 3 months. Then the time requirement kind of drops off after that stage because I've set everything up. I've automated everything. So yeah, I don't track it. Vladimir, what types of services are your clients offering? So it's all B2B professional services companies, marketing, cybersecurity, IT, B2B professional services, basically. Anybody that offers a service to a client as opposed to a physical product are clients that I generally work with. I do have a couple of tech companies as well, but they're more service focused as opposed to a traditional kind of SaaS model, that kind of thing. I think that's all the questions. Let me just refresh the feed just to see. Yep, I think that's it. Well, we are pretty much bang on time, 13:28. So we have 2 minutes. So I will just use the last 2 minutes to say thank you for attending this webinar, ladies and gentlemen. Oh, we have one more. Let me answer it. Do you have a 100% success rate of getting clients once you present a strategy document you spent 7 days preparing? 98%. I've only ever had one client, only ever one in 2 to 3 years that did not sign up because they wanted to go with somebody. They were wanting to switch accountants at the same time. I don't do any bookkeeping, compliance, anything like that. But they wanted somebody to do the bookkeeping, the compliance, an all-in-one package. They weren't just looking for it for a fractional CFO. Literally every other client signed up. Another question, time spent per client per month, say month 1 versus month 6. Month 1, again, it's not a metric I track. I don't track my time. So easiest answer to that question would just be a hell of a lot more in month 1 to 3. And then month 6, maybe, I don't know, 75% less, 80% less, because everything's automated. It's all set up in the background. All we're really doing is having a forecast meeting every month, putting together the Fathom pack, attending the board meeting, updating the forecast, and being available to help with any ad hoc queries that the client might have. Dan, after the first 3 months, how many hours do you spend with each client per month? I think I just answered that one. Somebody else asked a similar question. I don't track my time, so I don't know the answer to that one. But I can give you the minimum. The minimum is always kind of at least a couple of days a month. Yeah, that's about right. A couple of days. Trisha, thank you very much. Appreciate the kind words. Simon, thank you very much. Appreciate the kind words. Okay, that's us on time, folks, at 13:30. So again, thank you for your time. And if anybody wants to DM me, I'd love your feedback. If you thought this was good, DM me. If you thought this was crap, DM me. If you want to collaborate about anything, DM me. DMs are open. I'd like to hear from you. Thank you very much. Hope everybody has a great weekend. Have fun, whatever you are getting up to. Thank you and